What if I told you that on the busiest shopping day of the year, the world's most advanced financial trading system didn't just crash? What if it was deliberately shut down? This wasn't just some server bug. No, this was an event that might have just ripped the cover off a huge crack in the foundation of our global markets. Let's really dig into what happened.
And that's really the core of it, right there. The whole argument is that this wasn't an accident. It was an intervention, a desperate move, really, to stop the silver market from screaming a truth that the system just couldn't handle.
All right, let's set the scene. It's the crack of dawn, November 28, 2025. In those quiet, early morning trading hours, silver futures just go vertical. They blast right through $54 an ounce. A few minutes later, boom, they're over 56, and gold is absolutely screaming higher right along with it. And then, nothing. Just silence. Every single screen connected to the planet's biggest derivatives market, we're talking everything from oil to treasuries to metals, just goes dark. The only thing anybody sees is this bland, almost clinical message: trading halted, technical issue.
And just like that, the Black Friday blackout began. You better believe this immediately set off a firestorm, not just from regulators, but from every single trader and analyst on the planet, all scrambling to figure out what could possibly take down the entire Chicago Mercantile Exchange. The official story, well, it came out pretty fast. And, on the surface, it sounded plausible enough. The exchange blamed a glitch, a simple mechanical failure at their huge data center. But the question everyone immediately started asking was, does that story actually make a lick of sense? So here it is. The official reason from the CME group was a cooling problem. A failure in the chiller plant at their massive data center in Aurora, Illinois, caused the servers to get too hot. They said to prevent hardware damage, they had no choice but to pull the plug. A simple, technical problem. Case closed, right?
Well, this is where the official story really starts to fray at the edges. Because the minute you start to look at the details, the facility itself, the timing of the event, the sheer scope of the supposed failure, a very, very different picture starts to take shape.
You have to understand, this Cyrus 1 data center isn't some server closet in an office basement. It's a fortress built for global finance. It's designed with what's called N+2 redundancy. Now, all that really means is, for every single critical piece of equipment, like a cooling pump, there isn't just one backup. There are two completely separate backups ready to kick in instantly. The building is literally engineered to make the official story, one chiller failure taking down the whole show, almost physically impossible.
And then you've got the timing, which is it's statistically baffling. This whole thing happened on Black Friday, the day after Thanksgiving. I mean, this is by far the lowest volume trading day of the entire year in the US. The heat coming off those servers should have been at an annual low. So why on earth would a state-of-the-art data center overheat when it's under the least amount of stress right at the exact moment a critical market was exploding?
And this might be the most suspicious detail of all. See, the CME isn't the only one in this building. You've got major banks, massive hedge funds, huge cloud providers. All of them are in the same facility, using the same basic infrastructure. And guess what? Not a single one of them reported any disruption at all. The problem was surgically, and I mean surgically, confined just to the CME systems. The overheating only happened to them.
Our sources found this quote from a veteran exchange engineer who obviously chose to stay anonymous, and it really sums up the professional skepticism perfectly. For the people who actually build and run these systems, the official story just didn't pass the sniff test, not even close.
So if it wasn't a busted chiller, then what in the world was it? Well, the alternative theory says the problem wasn't technical at all. It was fundamental. The glitch was just a symptom of a catastrophic breakdown in the actual physical plumbing of the global silver market.
Okay, to get this, we have to talk about a term you almost never hear in a healthy market: super-contango. Normally, a futures contract costs a little more than buying something today, to cover storage and insurance. But super-contango, that's when that price gap becomes enormous. It's a giant red flag that something is deeply, deeply wrong with the actual supply.
This slide basically shows you the beating heart of the global silver market. Okay, so normally London is the world's hub for big physical silver bars, and New York is the hub for paper contracts. If London's supply gets tight, its price goes up. That signals traders to buy cheaper futures in New York, take the physical delivery, and ship it to London for an easy profit. That keeps the whole world supplied. But on November 28th, the market was in super-contango. New York futures were trading almost a full dollar higher than the physical price in London. The pipeline slammed shut. It made 0 cents to ship silver to London, which basically cut the city off from the world's supply.
And this breakdown, it didn't just happen out of the blue. The theory is that this was the dramatic final act of a months-long worldwide scramble for physical silver that had drained stockpiles down to critically low levels.
And this is what that scramble actually looks like. Just look at the inventories on the Shanghai exchanges, a key place for physical metal in the East. A few years ago, their vaults were overflowing with thousands of tons. By the time of the blackout, they held less than 1,400. That is a stunning, stunning drop.
But the real number? It's even more terrifying. Of what was left, analysts estimated that the free float, that's the amount that's actually for sale and not locked down by long-term investors, was less than 700 tons. Now, here's the crucial context. 700 tons of silver sounds like a lot, right? But for an economy the size of China's, that represents less than 6 weeks of industrial demand. The cupboards were going bare, fast. And this wasn't just industrial buyers. This time, nation-states were getting in on the act. And that changed the whole game. China was planning to basically halt its silver exports. India was bidding up any physical metal it could get its hands on. And sovereign wealth funds in the Middle East, they were done with paper promises. They started demanding actual, physical bars delivered to their vaults. All of this put an impossible strain on a system where there are way, way more paper claims on silver than there is actual silver to back them up. So the immediate result of the CME pulling the plug was pretty fascinating. It created this sort of forced experiment. With the official paper price frozen in time, the real-world market for physical silver was suddenly free to find its own true price level. And this is exactly what happened. The market basically split in two. You had the official paper price just stuck on a screen. And then you had the street price, what it actually cost to get your hands on a physical ounce of silver. The premiums, that's the amount you pay over the official spot price, reportedly exploded from a few bucks to as high as $18 an ounce. Now, we've seen stuff like this before, most famously with the Hunt brothers back in 1980, but this comparison really shows why this time is so different. In 1980, the buyers were just two speculators trying to make a profit. In 2025, the buyers are entire countries looking for strategic reserves. Back then, the exchange just changed the rules to force them to sell. This time, they just pulled the plug on the whole system. The outcome in 1980 was a crushed silver price. The alleged outcome now is a crushed sense of trust in the system itself.
So what does this all really mean? The sources we looked at argue the blackout wasn't just another market event. It was a message, a really stark reminder of just how fragile our complex digital financial world has become, and maybe a sudden reawakening to the timeless value of physical, tangible things.
And here is where it gets truly poetically ironic. Those data centers that supposedly overheated, the AI chips that power everything, the 5G networks that connect our entire modern economy, they all have one critical thing in common. They need massive amounts of silver to even function. The very technology that was used to halt the market is itself one of the biggest consumers of the physical commodity it could no longer price.
So to wrap all this up, the argument here is that the silver blackout was not a technical failure. It was a warning shot. It was a signal that the decades-long era of paper promises holding down physical reality might finally be coming to an end. And it leaves us with a really fascinating question for the future. What if the most important race is no longer about who has the fastest trading algorithm, but about who can actually get their hands on the physical stuff before the lights go out again?